As a long-term investor, there's actually very few companies out there that I would consider a buy and hold forever. And I've called Microsoft one of those companies before, and I'll call it again. Microsoft Corporation just reported their Q2 earnings after the bell, and shares are actually sliding 4.5% after they reported their earnings. Now, like I said at the top, this is one of the simplest, most effective companies to understand out there, and they've been doing this for 30 plus years, and I expect them to continue to post absolutely stellar results. We'll go through their earnings. We'll also go through the guidance which this company provides on the conference call. That's why this video is coming to you a bit later. Had to wait for the conference call, had to wait for the guidance. We'll take a look at the all-important different segments over at Microsoft. They're still growing the Azure business at a whopping 31%, and you're still getting growth on some of their other businesses like LinkedIn, like M365, like Windows OEM. So we'll take a look at all of that, and then when we get to the financials, it might just make your mouth water. Hey guys, hope you're doing well out there. It's been a while since we've taken a look at Microsoft Corporation. Very simple company to understand, but over the past 1 year, shares are up only, and I say only 8%, especially when the broader market is up significantly more. You also have other mega cap tech up more as well. Now, one of the reasons that might be is because the valuation is pushing up there. You're up close to 34, 35 times a forward earnings multiple. Now, keep in mind, a company like this certainly does deserve a premium simply because how high quality it is, but you are seeing shares trade off in the after hours, so we'll see whether there's some opportunities that lie in shares of Microsoft. Now, Microsoft is on a slightly wonky fiscal year, and so this was the end of their Q2, but nonetheless, it was absolutely stellar with revenues coming in at $69.6 billion. That was good for 12% year over year growth, beating estimates on Wall Street by roughly $800 million. Now, they also came in with a beat on the bottom line, and this is something this company just consistently does time and time again. They know how to play the game of Wall Street. They come in, set expectations just slightly low, and come in, have a stellar quarter, and beat those expectations. Now, across all three of their businesses, they saw pretty decent growth. In the productivity and business process, you saw revenues up 14%. Intelligent cloud revenues were actually up 19%. And then your more computing business revenues relatively flat, up to roughly $14.7 billion. Now, the important thing with Microsoft is you wait till 5:30 p.m. Eastern time to get onto the conference call where they provide forward-looking guidance. And that's exactly what they did for the upcoming Q3. Microsoft is anticipating revenues to come in between 67.7 up to $68.7 billion. Now, you're probably asking where that lines in with the average estimate, and it comes in underneath. So the average estimate on Wall Street was closer to $69.8 billion. So they're coming in at probably $1.5 billion shy of the average midpoint. And in fact, you had some high-end estimates as high as $71 billion. So they're coming well underneath those estimates on Wall Street. Now, sitting here 3 months from now, what I fully expect is Microsoft to come in with a beat on those expectations. As these revenue expectations get revised in the next couple of days, I think Microsoft knows what they're doing, and they guide for a little bit underneath what they actually probably anticipate to hit. Now, in the upcoming quarter, they also see Azure revenue growth coming in between 31% up to 33%. And you're probably wondering where that stands compared to the previous quarter. And previously, we got Azure revenue growth at 31%, which is pretty stellar. Now, it is a slowdown from a quarter ago where Azure revenue growth was close to 33%, but keep in mind, over 30% Azure revenue growth is very, very solid. It's been doing that for a long time. Now, on top of that, you look out maybe 5, 6, even 7 quarters. This company has a lot of analysts. There's a lot of people tracking Microsoft, and you notice something. They're just so steady in the way they grow their top line revenues, basically anticipating 13% revenue growth, call it into perpetuity. And that is just a fantastic business model. Whenever you're selling software that's so easily reproducible, where you can continuously bump up the price and it continues to stick around with your customers just because how essential it is, that is a phenomenal business model. And you see that in its revenue growth. And then on the earnings side, pretty much because you are a software business, you have high margins, you have high leverage. Yeah, a lot of those earnings also translate into bottom line profitability growth. So you're anticipating mid-teens growth both on the revenue and earnings side for the foreseeable future. And so when you look ahead, the valuation, sure, it's trading at 35 times the fiscal year ending in June. You look ahead to fiscal 2026, you're roughly around 30 times. So sure, you are slightly elevated on your valuation, but keep in mind this company is very consistent at the way it produces revenue growth and the way it churns into profitability. Now, from their different segments, the important segment is, of course, Azure. We talked about that. They're still experiencing very solid growth on that. That's where they're investing a lot in terms of infrastructure and data center build out. They're trying to meet capacity on the Azure side. For the past couple of conference calls, Satya Nadella has himself said that they have been capacity constrained on the Azure side. So basically, they just have too much demand from their customers for cloud computing, and they haven't been able to keep up with that demand. And so if they actually had more capacity, they would be able to generate even higher revenues. And I believe that's probably still the case, probably into the rest of the fiscal year. Now, in terms of their other segments, you still have Microsoft 365, which is their M365. Think about Word, PowerPoint, Excel, all the whole suite of M365 applications still growing in the mid-teens. You also have LinkedIn growing at 9%. And then the surprising thing is search and news advertising growing at actually 21%. So that's a pretty solid growth rate, both for LinkedIn and search. This company, while sure, it's no Google, it's no Meta in terms of its advertising business, it is still growing. And that tells you the underlying strength in advertising as a whole, but also probably the underlying strength in the way Copilot is now being used in Bing and their other parts of search, where AI is probably benefiting growth in terms of search and news advertising a little bit more than it would have in the past. The other thing you have is Windows OEM still continues to struggle relatively, up just slightly 4%. And then you have the Xbox content basically flat year over year. They've now completed that Activision Blizzard deal. And so you're not seeing that huge revenue growth there, considering the fact that they've lapped that Activision takeover. But all things considered, look, the Azure is the important one. And then you also have growth in M365, which is a lot of their Copilot rollout. Now, in terms of the income statement, like we said at the top, it's a very simple income statement to analyze, and it's very, very effective in the way they grow their revenue. So $62 billion is what we had last year. This year, that churned up nicely to $69.6 billion. So basically, $7.6 billion is what you add to your top line. The cost of those revenues tick up relatively in line. So you're not necessarily improving your gross margin from a percent basis, but you are absolutely improving it from a dollar basis as you go from roughly $42.3 billion in gross margin up to 47.8. And over the last 6 months, similar story, $82 billion in gross margin, now at $93 billion in gross margin. Again, just over the last 6 months, guys, that is a staggering figure. On top of that, your R&D expense relatively actually in control from 7.1 up to 7.9. Sales and marketing basically flat year over year, and you're seeing your G&A actually tick down. That's right, tick down despite adding $7 billion on your top line. And so there you go, your operating income steadily increases from 27 up to $31.5 billion. Similar story on a 6-month basis, you're at that $31 billion run rate every single quarter. And on top of that, that flows down to your bottom line earnings, which continue to look absolutely stellar. Now, from a balance sheet perspective, it's not great, I would say, but it's certainly nothing to be overly concerned with. You have $71 billion of cash and cash equivalents over the last 6 months. Did dwindle down just a little bit, but from a liability perspective, you do have a fair amount of long-term debt, close to $40 billion. You have another $5 billion in terms of the current portion of that long-term debt, so that will be maturing over the next couple of quarters. Now, this company used to have a very pristine balance sheet. This got bolstered up in terms of debt just a little bit due to that Activision Blizzard takeover, and I certainly expect this company to, over the next couple of quarters, with their free cash flow, begin to dwindle down that debt. Now, with the M&A activity probably heating up with the new administration, you could certainly make the case that Microsoft is still in a very good position to go out there and make acquisitions. They certainly have the cash on their balance sheet, and also from a cash flow perspective, they're generating just huge amounts of operating cash flows to the tune of close to $22 billion. And so that gives them enough leverage to the point where they can go out and make acquisitions, whether that's tuck-in acquisitions for small AI startups or larger companies, like the potential takeover of TikTok. Now, I don't think the regulators will probably allow a TikTok takeover to happen, but certainly if it does, well then yeah, that search and advertising business will absolutely get bolstered up with a takeover of TikTok. Now, in terms of the way they use that free cash flow, first of all, they spend quite a bit in terms of Capex. This company did announce that nearly $80 billion of fiscal year 2025 Capex. And so over the last 6 months, they've done about 30 billion of that. But that should tell you over the next 2 quarters, Microsoft plans to spend exactly $50 billion on Capex. So you can expect this $15 billion run rate to tick up to maybe $25 billion next quarter, and then even higher in the subsequent Q4. So that should tell you that the spend over at Microsoft, really over at all these hyperscalers for NVIDIA GPUs, for Broadcom networking, for TSM manufacturing is absolutely still there. And that should tell you the demand for the semiconductor companies will continue to remain, at least for the rest of this fiscal year. And so that leaves them with around $7 billion of free cash flow, because you have this 22.2, you take off nearly $16 billion in Capex. And so what they do with that is they buy back shares to the tune of $5 billion, and they pay out a nearly $6 billion dividend over the last quarter. And that's really the pace they've been on for the last 6 months as well. So all things considered, from a financial perspective, this company is churning through huge amounts of operating cash flows. They are certainly investing heavily into Capex, considering the fact they're probably still a capacity constraint on Azure, at least until the end of the fiscal year. And then beyond that, they might pull back on the Capex spend, which certainly could affect semiconductor companies. Now, from a technical perspective, though, you are seeing that pullback, considering the fact in the after hours, you were down roughly 5% after hours trading really close. You were down to $421 a share. Now, that does coincide with the bottom end of our uptrend down here at $420 a share. So you could make the case there is some level of support here, and you could maybe look to pick up shares of Microsoft at this point. Certainly, if you are long shares of Microsoft, if you've owned this one for years and years, yeah, you could absolutely continue to nibble in on these dips. There's nothing to really be concerned about. You could absolutely see a reversal from here and continue to move higher. But even if you break down lower down to these 400 within this green rectangle, that's where I would get far more aggressive in your buys. That's where I would be a bit more excited in picking up shares and adding to a position in Microsoft. I think the range here and the valuation you would get once Microsoft pulls into this $360, $370 range would just be a bit more compelling. But if you are certainly a long-term shareholder, you have the uptrend in your favor, and there's absolutely nothing in these results that I would be concerned with. In fact, they were absolutely stellar. It's just the guidance came in a bit lighter, but in my opinion, that's what Microsoft tends to do. They sandbag a little, and next quarter they'll come in with another beat. That was my take on shares of Microsoft. With this one, you get a yield, you get a buyback, you also get investments back into themselves through the form of Capex, you get a strong balance sheet. What more could you ask for? Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening. I'll catch you guys in the next video.